The AI bubble didn't steal your money. It trained you to hand it over on a silver platter. First came the pretty promises: artificial intelligence changing the world, chips turning into gold, data centers like mines, billionaires selling the future, and Wall Street calling it all a revolution. But while you saw headlines about innovation, the system saw something else: liquidity. He saw millions of workers with 401ks, small investors with apps in hand, and people tired of inflation looking for a way out. He saw ordinary people trying to protect what little they had left after expensive groceries, high rent, high interest rates, and stagnant wages, so they packaged fear as opportunity. They called anxiety investment, they called a casino the market. And if you want to understand the unscented economics of Wall Street at the crime scene, sign up now, because here we call a bubble and an elegant scam a scam. Now the music is fading. AI was just the trailer. The American debt is the main movie, and when Washington spends, Wall Street profits, and the average citizen believes the next narrative, the real question isn't who got rich. The question is who's left to foot the bill, and the exit strategy actually closes. Before them came cryptocurrencies, electric cars, the space economy, NFTs, and dozens of promises sold as the next revolution capable of creating an entire generation of millionaires. Notice the pattern: the product changes. The emotion remains exactly the same. First they say the world will never be the same again, then they show graphs rising relentlessly. Next, experts, influencers, and billionaires appear saying that those who stay out will regret it for the rest of their lives. Suddenly, not investing seems more dangerous than investing. The fear is no longer about losing money, the fear becomes about missing an opportunity. This is the real product sold by Wall Street, FOMO. Because nobody buys a stock just because of its financial balance sheet. People buy hope, they buy status, they buy the feeling that they've finally found the shortcut that everyone else hasn't yet seen. And when the price goes up, they confuse appreciation with confirmation. The more expensive it gets, the safer it seems. The more people get in, the fewer people ask questions. That's exactly what happened with AI. Companies that could barely explain how they would turn all that excitement into profit became worth hundreds of billions of dollars. Any company that added two letters to its narrative seemed to get a free pass to raise money. Investors weren't buying results, they were buying a story. And stories are dangerous when they replace mathematics. The biggest winners understand this. They know that markets are driven much more by behavior than by spreadsheets. While millions chase the next revolution, those who got there first are already discreetly looking for the emergency exit. This is where many people still believe the problem is just a tech bubble. It's not. The American market has stopped functioning as a place to invest and has become like a casino open 24 hours a day. Your cell phone has become the betting table, your feed has become an advertisement. Every notification says there's an unmissable opportunity. Every influencer seems to have discovered the next asset that will multiply in value. Meanwhile, Wall Street needs only one thing: new liquidity, and it comes from ordinary people. It comes from the worker who automatically deposits money into their 401k account every month. It comes from the small investor buying ETFs without even knowing which companies are in them. It comes from those who believe that investing simply means buying anything that is going up. When the market enters a state of euphoria, large funds are already distributing assets to those who arrived last. Insiders realize profits. Executives sell shares, banks collect fees. But the average investor believes they finally got in at the beginning of the party. In reality, he came in when the music was already ending. And the more people believe that this time is different, the greater the liquidity available to those who need to get out first. If you've noticed that your feed looks more like a casino than financial education, leave a like and comment, "Casino down here." I want to know how many people have already realized that this system depends much more on the emotions of the masses than on the fundamentals of companies. Because the casino never goes bankrupt, it just changes the players. Yesterday's losers return tomorrow convinced they've finally found the perfect bet. And Wall Street continues doing exactly what it's always done, turning hope into liquidity and liquidity into profit. The real bubble is America's addiction to debt. That's when the story stops being about tech companies and starts being about the entire financial system. Imagine a family that spends far more than it earns each month. At first, They use credit cards, then they take out a loan to pay off the credit card. Later, they take out another loan to pay off the first, the debt grows, the interest increases. And there comes a point when working is no longer enough. A large portion of their income exists solely to pay off the debt itself. Now imagine this in the largest economy on the planet. Every year, Washington collects billions in taxes, but it spends far more than it receives. To cover this difference, the government issues U.S. Treasury bonds. In other words, it borrows money promising to pay it back in the future. For a long time, this worked almost flawlessly. Interest rates were low, there were enough buyers. The whole world was willing to finance this machine, but mathematics began to change. The larger the debt becomes, the higher the interest payments need to be to convince investors to continue buying these bonds. And when the government pays more interest, that money doesn't appear out of thin air. It has to come from somewhere. This is where almost no one makes the connection. While you were looking at headlines about artificial intelligence, billions of dollars were being poured into simply keeping alive a machine that relies on new debt to pay off old debt. The AI bubble grabbed all the attention. But the real-time bomb continued to grow silently. And when an economy becomes dependent on debt to sustain growth, the question ceases to be ... double quotes, how much does the government owe? The question then becomes, who's going to foot the bill? It appears when inflation insists on returning even after so many promises of control. It appears when the Federal Reserve keeps interest rates high for longer and financing your house, your car, and your credit card becomes increasingly expensive. It appears when companies reduce hiring because credit has become too expensive. It appears when the cost of living rises faster than your salary, but it doesn't stop there. The more money the government needs to spend just to pay interest on its own debt, the less is left for everything else. The pressure for new taxes increases. Cuts to public programs become impossible, benefits come under scrutiny. And millions of workers who entrusted their future to the 401k discover that a large part of their retirement remains entirely dependent on a market that needs to grow for the system to continue functioning. Meanwhile, whenever some important piece threatens to break, a new justification emerges to inject more liquidity, create new stimulus packages, or bail out institutions deemed too big to fail. In the end, the transfer happens almost invisibly. You lose purchasing power, you pay more interest, you take on more risk, you work more years, and you still hear that all of this is necessary to protect the stability of the economy. You don't get a vote when the bill arrives. The truth is, the bill is never split equally. Those closest to the money printer feel it less. Those living on a salary, savings, and retirement income feel it first, and they feel it more intensely. When a giant bank takes absurd risks, when a billion-dollar fund makes irresponsible bets, or when a major company teeters on the brink of collapse, the narrative always emerges. They say it's too big to fail. They say the entire system depends on it. They say there is no alternative. Then the money appears. But when an ordinary family loses their home because interest rates have doubled, nobody says it's too important to go bankrupt. When a small business owner closes their doors after years of paying off increasingly expensive loans, there's no press conference. When a worker is drowning in credit card debt, nobody organizes an emergency package. For those at the top, there is rescue. Those at the bottom face the consequences. This is the real reason so many people are outraged with Wall Street. Profits are private. Losses end up being socialized. And every time a big mistake needs to be hidden, the bill simply changes address. It arrives through a weaker currency, through higher public debt, through future taxes, through persistent inflation, through higher interest rates for longer. The bailout never goes away. He just switches pockets. And, almost always, it ends up exactly where the system knew it would from the beginning, in the pocket of someone who never participated in the decision, but always participates in the payment. The chart changes, the sector changes, but the behavior remains identical. First comes euphoria, then greed, next, the fear of missing out. Then the experts appear saying that this time everything is different. And, when reality finally catches up with fantasy, panic makes the same people sell at exactly the worst possible moment. This is how wealth changes hands. They don't need you to understand macro. They only need you emotional enough to buy the top and scared enough to sell the bottom. This is the real game. It doesn't matter if tomorrow it's artificial intelligence, robotics, nuclear energy, quantum computing, or any other promise sold as the opportunity of the century. As long as you continue making decisions based on fear, euphoria, or headlines, there will always be someone willing to sell a new story to buy your liquidity. The system doesn't need you to be uninformed, he just needs you to stay emotional. First, confidence disappears, then liquidity disappears. And finally, someone has to absorb the losses. Wall Street knows this. Washington does too. The only question that remains open is who will be turned into the emergency exit this time. If you've made it this far, you've already realized that this channel isn't just about markets, we talk about behavior, because it's the behavior of the masses that creates bubbles, fuels crises, and allows the same script to be repeated generation after generation. AI was just the trailer. The main film is an economy built on mounting debt, cheap money whenever it suits the big players, and a population convinced that the next narrative will finally solve all the problems, but the bill always finds someone, and, almost always, she finds the person who least participated in the party. If this video finally made that debt machine make sense to you, leave a like and write ... double quotes bill in the comments. I want to know how many people realize that the biggest risk was never just the AI bubble. It was the entire system that made that bubble possible. Now watch the video that's appearing on your screen, because it shows another part of this same trap that almost no one notices before the bill comes due. The bubble bursts on Wall Street, the bill arrives on Main Street,